So we're going to ask as to what are the challenges and the solutions for the sovereign wealth funds. We're going to ask what roles can you play in the promotion of co-investment platforms in both domestic and regional projects. And if you're in formation, how do you see the funds being organized and the issues? For the pension funds, we're going to ask what are your infrastructure investment strategies and mandates? What role can you play in the promotion of co-investments in domestic and regional projects? And try to drill down a bit into into both the planning, the allocations, the challenges of identifying bankable projects. So we're going to start with Mabu Wagachi, the Senior Economic Advisor in the Executive Office of the President for Kenya. And we know that Kenya has been a leader on so many fronts with regard to innovation in finance. I think most recently with the retail bonds for buying government instruments. So if you could talk to us a bit about your plans and what are the things that you've already determined in this process and how you see the decision making for allocations to regional infrastructure projects. Thank you.
I think I'll share with my friend here, Mr. Mbai, share the mic. Now, my name is Wagasha, as Bui Wagasha, as stated. I come from the banking world, African Development Bank, and then I was the chairman of the Central Bank of Kenya, and now I'm the senior economic advisor to the president and chaired the architecture on the Kenya Sovereign Wealth Fund. So I'm going to talk a little bit about that architecture, and it focuses quite strongly on infrastructure. We have three windows of the National Sovereign Wealth Fund bill, which is going to Parliament. The architecture contains three windows. The main window is infrastructure, 40%. The other windows are stabilization, 30%, and the future generations window, which is 30% as well. The importance of infrastructure is underlined in the allocation of 40% in the bill going to Parliament. We have that as the kind of prime commitment to have infrastructure financing from the Sovereign Wealth Fund. There's a second aspect of the fund, which is its earnings globally. It is invested in accordance with guidelines which are developed by the Minister of Finance, approved by the Council of the Sovereign Wealth Fund. The real rate of return on that fund, real rate of return on earnings, is allocated to the budget, which allows the Minister of Finance to include infrastructure projects in the financing, finance from the real rate of return on from the fund. Thirdly, when there is any extraordinary request from the Minister of Finance to finance projects or for whatever reason, each of the sub-funds, which is stabilization, infrastructure and development, and future generations fund, can be tapped to a certain degree to allocate a little more money to projects. But that amount is limited. We limit that amount in the case of the Future Generations Fund is limited to 0%. So in a sense, you cannot draw money from the Future Generations Fund to finance infrastructure. conceptually, what this means is that current generation infrastructure funding is a net contribution to future generations, because the future generations fund is not drawn upon at all, to finance infrastructure. But you can, in extraordinary circumstances, you can draw from the stabilization fund 10%. You can draw from the infrastructure and development fund 10%, the extraordinary amount that is allocated outside of the normal funding. So that's the architecture of that fund. So that is what we are taking to Parliament. It's called the Sovereign Wealth Fund Bill 2014, and it will be debated in Parliament. Once passed, the rest of the architecture will fall in place with a council, with a board of directors, and guidelines. I wonder what, I would like to stop there, and we'll be able to answer any questions. Thank you.
Well, it is extraordinarily exciting. And if I can share a little bit of the exchange we had before coming here, when I asked about the allocation for regional infrastructure projects, as I understand it, that needs to be determined by the Ministry of Finance. Yes. So, as we talked a bit yesterday, the devil's always in the details. How do we think through what are the fiduciary responsibilities? How do you deal with currency risk? All these kinds of good issues are, I think, on the table right now to be thinking through. And with that, thank you. We will now turn to Rinosi Mogate, chairperson of GEPF. And this is the case of a South African pension fund that has funds that could go to both national and regional infrastructure projects. But as she will point out, they are now underallocated due to the lack of bankable projects, and discuss some of the challenges. Thank you.
Thank you. I think in terms of the issues that have been raised for us to address as pension funds, what I'd like to say, maybe to say a little bit about the Government Employees Pension Fund. It's the largest fund in South Africa and on the continent, and as well as being one of the top 10, with approximately $110 billion under management. In our initial phase, we invested only in South Africa, and then in 2010, there was a decision to also allocate 5% for investment outside of South Africa. For investment outside of South Africa in various types of investments. Within that universe, infrastructure looms very large, particularly because that's an essential aspect for enhancing development on the continent. So our strategy is guided by two policies: a broadly policy on responsible investment, and then we've got also a development investment policy, which basically says, as a long-term investor, we are ready to invest in projects that offer us a good return, in addition to having an impact from an economic development, social, and environmental point of view. But what we find is that the amount of money that has been allocated is actually moving very slowly. And the challenges that are being presented, many of them were discussed previously. But for us as a pension fund, what those challenges mean, i.e. the challenge of not finding bankable projects, the risks that are associated with not having a proper regulatory framework, institutional capacity, human capital capacity, and so forth. what we have learned is that it means that we need to find good partners, first of all, on the ground, with whom we can co-invest. And secondly, that we also need to find partners that can address those challenges that have been highlighted. So in some cases, the funds through which we have invested have worked very closely with governments to build up the regulatory framework and create the environment that is necessary for those investments to occur, but that means that those investments then take quite long. So what we look forward to is some kind of framework that allows us to make the kind of impact we can make as a long-term investor by partnering with people that can take up the various risks that come with investing in infrastructure on the continent at the moment. I'll stop there.
Thank you. So you see, there's more money for bankable projects. We just have some work to do to get there. So I thank you for putting forward the challenge. We're now going to go to Gerald Paul Casuto, Chief Investment Officer. Very important, the credit function, right, for bankability of the National Social Security Fund of Uganda. And here, there's a really interesting strategy of investing with intermediaries that help ensure the quality of the investment, and also, in one case, a AAA rating. And as I understand it, without any sovereign guarantees or liabilities for Uganda. Gerald.
Thank you so much. Let me first introduce myself, Gerald Paul Casato, from National Social Security Fund. For those of you who are not familiar with NSSF Uganda, it's the largest pension fund in the country. Assets under management currently stand at about $2 billion. The investment portfolio is mainly invested in fixed income, and about 73% of the portfolio is actually invested in Uganda. Our mandate applies to the East African region. That has been determined by the regulator. So we have invested part of the portfolio to the region. In terms of infrastructure, the strategy we are trying to adopt has been indirect because of some of the risks that come with certain projects. For instance, if it is, depending on the sector, if it is a road or say a mortgage or housing, we prefer debt, and we prefer to partner with a AAA rated entity. We have done, for instance, an investment which has been backed by the ADB. It was a bond that was to finance the mortgage sector recently, but we are currently in talks with another bond which will finance an express highway in Uganda. But also on the equity side, we have done an investment with PTA Bank, and I'm glad the CEO is here. Again, it is one of our strategies to actually do indirect investments, because we do not prefer, just like any other pension fund, we do not prefer to take on development risk. We do not prefer to do greenfield investments. We prefer brownfield, and if there's an opportunity to partner with a strong entity, we prefer to go down that route. But having said that, the expectation from our stakeholders within the ministry is that we should actually participate more. Currently, the infrastructure needs of Uganda are in excess of $10 billion, but like I said, we're only a $2 billion fund. And because of the need and because of so many projects that need to be financed, actually government is taking on non-concessionary borrowing to finance some of these projects. So the expectation is that we should participate more. However, we are mindful of our stakeholders who are the members. They expect a decent return. So that explains why In terms of managing risk and return, we prefer partnering with entities, and in that case, we prefer indirect exposure.
And one thing that I forgot to point out, which I found really interesting, is that your internal allocation, as I understand it, for regional infrastructure projects is 25%. Is that correct?
No, actually, the regional allocation is 25%, but that is not specific to infrastructure.
Ah.
Yeah? That is for the entire, for all other different asset classes. It can be 25%. But for instance, I can tell you that 1% of our portfolio has actually been invested in Kenya government infrastructure bonds. Yeah.
Let's talk more about that later. but I'm just trying to illustrate the point, is we have work to do to be able to balance the need, as you said in Uganda, 10 billion alone for infrastructure with the structures, the responsible, well-structured, bankable projects that are going to ensure your retirees are not compromised. So, you can see the potential. Thank you, Gerald. Okay. So now we're going to go to another sovereign wealth fund that's in its planning stage. So Simon Norata is the Director of Economic Research and Special Projects and Policy Advisor to the Zimbabwean Sovereign Wealth Fund, Reserve Bank of Zimbabwe. Simon.
Thank you. Okay, thank you. As mentioned, I'm from the Reserve Bank of Zimbabwe, and the Sovereign Wealth Fund of Zimbabwe is still in its formative stage. The bill of 2014 was passed by Parliament, and the board has been set up, but the fund is not yet operational. The whole idea is that the objective is to transform the non-renewable assets to financial assets for the economic and social development of the country. And in the bill, it states that there are three major areas of focus, and as a result, there are three funds which are going to be put in place. The first one is the infrastructure fund that will look at the rehabilitation and development of all the infrastructure, including road, rail, telecommunications, and energy. At the moment, government is working on the feasibility and bankability of projects in these areas. I would like to mention two of them that we actually share with our neighbor Zambia. That is the hydroelectricity projects along the Zambezi River, the Kariba North and South, and also the Batoka Gorge. So the feasibility is being worked out, particularly on the Batoka Gorge, and we are hoping that the Sovereign Wealth Fund, once put in place, will be able to contribute to the development of that infrastructure together with other players. The second fund is the Future Generation Fund, which is obviously one of the major reasons for the management of natural resources. And then the third one is the Stabilization Fund, whereby government can be funded from the sovereign wealth fund when there are deficits and also source of funds that would be dwindling. In this case, in the bill, it states that the money should come up from the gains of the investment of the fund. That will stabilize the fiscus. When we come to the major sources of the fund, it is anticipated that the source of the fund will be up to 25% of the royalties that are raised from the production of all the minerals. But the board is mandated to look at other sources of the funds, and at the moment, the board is trying to find out where it can get some of the funding because of the decline in commodity prices, which means that income from that end has been dwindled. Thank you.
Thank you, Simon. Do you have a sense of the estimated size of your sovereign wealth fund that's going to be allocated to infrastructure?
Not yet. In fact, the board is actually trying to come up with the allocation between the three funds.
Very difficult processes, I am sure. Thank you. So we're now going to turn to Manadu Mabai, who's Executive Director and Head of Energy and Mining and Capital Raising for FONSIS in Senegal. Now, it's very interesting. FONSIS, in this global debate, through its director, has had a very meaningful voice at the global level in this whole from billions to trillions. Amadou, in fact, is a member of STIP, the OECD World Economic Forum initiative, where every month they look at transactions to bring together the DFIs and the bilateral partners. USAID is a big leader in this to actually get deals financed. And their target is $100 billion of getting deals done. So it will be really interesting to hear from you, Manadu, about the investments that FONSIS has been able to make to date. And also your national priorities of investing in national infrastructure despite an allocation of 20% to regional projects.
Okay, thank you very much, Barbara. Good morning. At FONSIS, actually, the fund was set up 3 years ago, and it has assets of a little bit over 1 billion USD. But the idea of the fund initially was really to use public funds as a leverage to attract private money into the Senegalese economy. So when we invest in a project, $1 of our money seeks to attract $10 of private investor money, be it equity or quasi-equity. And we have been successful doing that in different infrastructure projects and some projects in the services sector too. But the main idea for us and the main challenge has been on some of those infrastructure projects actually to structure the debt side of a project. The debt side is an issue because, well, our main counterpart on that field are DFIs, which are very effective in bringing the initial money. But we think that with that global economic environment where you have asset owners fighting for opportunities to invest, and the African continent seeking to finance its infrastructure development, there is on the debt side a real opportunity to structure something to bridge the gap between institutional money and actually project finance. It is true that project finance is not structured in a way that it really can welcome institutional money, traditional asset owners' money. So we have to find a way maybe to structure, this is financial engineering, but you have to find a way to structure an entity that's going to be a good investment vehicle for asset owners and at the same time solve the debt financing problem of infrastructure on the continent. And this is actually a global question because if it's sorted out in Africa, it will be sorted out elsewhere. And in those infrastructure projects, there is something very key. You have the construction phase, which is the risky phase, actually, the risky one. And you have the operational phase, which is a little bit different because when you get to operations, actually, you have a business, you have contracts in place, you have revenues, actually the facilities are finalized, they can be put as a guarantee. So we are in another risk environment where maybe pension funds and sovereign funds with fiduciary requirements would be able to actually get in. On the construction phase, on the other hand, you may have a more risky lending environment where maybe banks would be more effective to get into play. So if we can think about two types of debt financing structures, one for construction, seeking to actually link to banks and maybe DFIs, and one for the operational phase, which is going to speak more to long-term investors, because construction is 5 to 6 years, operation is 20 to 30 years. Long-term investors, be it the debt side of institutional investors, that can be insurance, but it's global asset owners, can be pension funds, it can be sovereign funds. There maybe we could find a solution to one of these issues we think about, not speaking about guarantees. So I want to stop there, but those are a few ideas I wanted to drop on the discussion.
Well, thank you. And you were alluding to a specific structure that I'll just quickly put on the table, which we actually started to discuss with the pension funds in Uganda and Tanzania, and then the DFI that was supporting us, their program just ended. Anyhow, financial engineering, very simple. You could design a contingent refinancing facility for pension funds to increase the de facto tenor to whatever you need, 20 years or whatever. So the front part of the financing is the banks provide the funding for the construction risk, which is the risk that they're able, and very important to impose that market discipline. And then there's a takeout facility that the pension fund or the sovereign wealth fund says that at the end of construction, provided there's cash flow and it's performing operational per the fiduciary due diligence requirements of that pension fund or sovereign wealth fund, they are prepared to fully fund it. You know, what will happen de facto is most banks will say, great, it's a performing asset, we're just going to have an evergreen asset and keep turning it over. Pension fund makes money on its fees, it's got reduced risk, and then we can scale. But these are the kinds of financial instruments we need to just create, pilot, and scale. Because we know, especially with Basel III, banks are going to be pushed more and more to the short term. They're already short term enough. So we need these financing solutions. So to our final participant, we haven't had a chance to talk in detail. But he is from Nigeria, Charles Amakanam. How do you say it? Okay, thank you. Chairman of the Nigerian Mortgage Refinance Company. And what's very interesting here is the Nigerian Sovereign Investment Authority, as I understand it, actually invests in your company.
That's right.
Thank you.
Thank you very much. So I'm here at a very, ladies and gentlemen, good morning. I'm here at the very last minute, Madam Chair Lady, on the invitation or the request of a friend of mine who's on the board of the NMLC, who is Uche Orji, who is the CEO of the Nigerian Sovereign Investment Authority, which was set up in 2011. Uche is in London, and at the last moment he said to me, you know, since we're working together on the NMLC, wouldn't you kindly come and say a few words? So with some arm twisting and a promise of a good glass of Cabernet Sauvignon, I was persuaded to do that. And I hope I can substantially make a few points and contribute to this, Madam Chair and colleagues here. I would start off by saying that Nigerian Sovereign Wealth Investment, Nigerian Sovereign Investment Authority was set up in 2011, and it's led by Uche Orji. It subscribes to the Santiago rules. It has won a number of awards. In my view, it's too small relative to the size of the economy, far too small. If you look at the metrics of the population size or GDP size relative to the size of the fund, it's too small. But it is going to grow, and Uche has been instrumental in pushing it. Now, some few points in the interest of time. It subscribes to high governance. It has a lot of applications for funds in Nigeria and in West Africa, but it's limited not only by its size, but by the credit quality of some of the projects that have been brought to it. And I think this is a universal challenge. It's one of the reasons I like the point made by Mamadou about financial engineering, and your point, Madam Chair, with regards to where we need to go to from simply having funds, having the demand for those funds, and then finding a way in which we can actually innovate and create ways in which we can expand the utilization rate of the funds. I think that's our challenge. We know, for example, that, as you rightly pointed out, that there are going to be restrictions on senior debt and the utilization of senior debt by banks, which means that we need to somehow deepen the financial system and develop the instruments. For example, from the mortgage side, we have analogies which give us some indication of where we can go towards the infrastructure side. For example, the whole convertible debt obligation structuring there, where you have tranches of different types of debt, all the way from senior debt down through to junk debt. And you wonder whether or not, with the right regulatory framework, you can structure projects in such a way and parcel them, infrastructure projects, in more or less the same way. But that's very dependent on the regulatory framework being robust. It's dependent on the transparency of the instruments. It's dependent, frankly, on the quality of the governments, or the quality of governance that supervises the financial system itself. And if there's no credibility there, which is still one of the challenges that we face in the development of these instruments, and it'll be very difficult to get the international investment that you require to match anything that a sovereign wealth fund wants to do. So, Madam Chair, I have a few other comments, but I just thought that with that, my slant is towards how do we innovate, and how do we go beyond where we are right now, given the limited amount of funds that we have, relative to the demand that is obviously there, and how do we structure and present and package the actual projects in such a way that they're attractive to not just the sovereign wealth funds, but to the broader investment community. Yeah. Thank you.
Yeah. Charles, I thank you. I mean, one thought that comes to mind as you all speak is bankability requires an understanding of investor criteria. And I would submit as a hypothesis that all of you sitting at this table, whether you're pension fund, sovereign wealth fund, have investment criteria that is totally consistent with the private sector. So, Amadou, when you talk about a leverage of 1 to 10, wow, wouldn't that be cool? So, you know, we've talked yesterday a lot about how to work together, partnership, and I wonder if one initiative isn't simply, and Uche, for example, sent me his investor criteria, okay? Why can't we just have transparently everyone's investor criteria and use that as a basis to build momentum, to partner together? And, you know, actually, you know, this is all about also learning from one another, refining, and then related to that, what you were saying, the financial engineering, to really think about how do we work with the other players, whether it be the banks, and to leverage. But with that, we only have a few minutes. I see already we have one question. So why don't you please identify yourself, and is there anybody else with questions? Okay, 2 questions. We'll take the 2 questions, and then we'll move because we're late. Please. There's a mic here first.
My name is Mpokolo Magara from Rand Merchant Bank. I just want to ask a question to the panel. If you have two sides of the coin, basically owned by the same shareholder, for the lack of a better word, so you've got governments who've got budget deficits, you've got sovereign wealth funds, pension funds who've got excess funds, both in local currency. Where is the gap in extending the tenor in the bond markets as opposed to the T-bill market being overcrowded, which could then open up, as a commercial bank, other projects, as has been mentioned earlier, for swaps and bonds, which could then potentially entice or make it a lot more palatable for IPPs to start considering local currency paying PPAs, which then solves the problem that most sovereigns are facing now when it comes to defaulting under PPAs for those who are.
I'm not sure that at least I got the question. Can you just restate it? You're looking at local currency PPAs, right? So, and you're thinking about local currency bonds, okay? So you're asking what's the gap between what do we need to do to be able to do that? Oh, I see. Well, that makes total sense. Okay. Who wants to deal with that?
There should be no gap if you, depends on how you measure this, because if they're running a deficit, you pointed out that the government's running a deficit, and then you're saying that there should be a demand, based on the PPAs. And if I get you right, then therefore, if the government's running a deficit, so the credibility of the government bond is less than an alternative source of finance. So the gap that exists there is the credibility gap of the funding source, which is the government, because it can't, because of its deficit, it can't fund. Then
well, wait. Can I just interject? Are you talking about the lack of creditworthiness of off-takers?
No, I'm just saying the lack of liquidity in long-dated bonds, which can be created by governments requiring funding, as well as pension funds who've got domestic currency liabilities.
So in a paper swap, would that not imply a paper swap then, which is a transfer from the surplus that exists in the pension funds directly through to the government at a preferential price? Because if the government did it, then it would be at a price that the market would have to charge for the fact that it has a deficit.
Which is fine, but why not create an active market where you have additive participants? Because if you've got an active bond market, then you have DFIs, you've got private players, you've got individuals playing in that market to then increase a lot more financial engineering to enable us commercial banks or other investors or financiers to put more structured products in the market.
I think, Madam Chair, that one would tier that. So you would, if I could say, what you do is you would actually tier it so that you would have, and it goes back to that whole CDO thing, which has got a very bad reputation, I must say, ladies and gentlemen, but it's a wonderful instrument if it's used well. Our challenge in some of the markets that we operate in is that the markets aren't very deep. And so that the kind of financial engineering that is possible isn't actually probable at this point in time.
Okay, that's great. It seems like there might be some room for follow-up in financial engineering, but Manadu wanted to say.
No, I want to say that, you know, if you take the example of a country like Senegal, we have allocated funds which are basically in our accounts, and we actually place that with local banks because it's available there. And we need that flexibility when we actually are financing projects. But this is money from the state. And at the same time, the government is actually raising funds on the market, and the banks actually receive our current account. They actually lend to the government. So the government is actually in a situation of borrowing its own money. And why is that? It's because we need the flexibility on our account when we're actually managing and investing in projects. So we need that cash in the account. We cannot be dependent on the budget specific requirements to actually make the funds available on our timing, because it won't happen. So if you want to actually effectively invest with public money, sometimes you run the risk of having those gaps in terms of availability and liquidity.
Okay, you know, this is exactly the kind of discussion, I would argue, that needs to be put together with experts from across the investors, the target investors, the banks, the DFIs to create products. So thank you, and I encourage you guys to do that. We have one more question. Please identify yourself.
Mulinga Karangwa. I work for PTA Bank in the equity department. And my question is for Gerald. So the developments in Uganda are quite remarkable in terms of growth, the 2 billion of assets that you're managing now. Most of it is coming from growth. And also this 25% regional allocation is a bold choice. And I was wondering whether you could tell us what made that possible in Uganda. In the rest of East African community, the allocation is usually entirely national, and the growth is much slower. So was it regulations, was it leadership, and do you think that your neighboring countries, follow pension funds in neighboring countries are going towards the same direction?
Thank you, Umlinga. Like you said, I mean, we've been quite active in the region, the East African region, and I know also you've alluded to the issue of governance that comes with pension funds in the region. Lots of changes in the boards of trustees and senior management. But the way we're looking at the region is because we're a pension fund that is actually growing, that has actually outgrown the Ugandan market, right? We are growing at an average of 25% year on year. When you look at our stock market, for instance, you only have 8 local companies listed. You have 16 companies in total, but the other 8 are actually cross-listed. So the reality is that if you're going to have a decent return to your member, you have to think about a regional strategy and then forget about looking at the local strategy. 3 years ago, 99% of the entire portfolio was invested in Uganda. But when you look at the returns we're offering to members, it was single-digit returns. When you look at the last 3 years, we've managed to sustain double-digit returns to our members. We've managed to beat inflation in the last 2 years. And I think, I believe we are the best performing pension fund in the region in terms of not only governance, but also in terms of our return, the returns that we give to our members. But it is a function of looking at the investment universe that you have, looking at the opportunities that you have in the local market, and then looking at what you can do with what you have, right? So I don't know whether I've answered your question, but that's how
I would encourage you guys to continue this because we need to move on. If there are other questions, please talk to people during the break. We're going to move to the break. But I have to say, and I'm always a bit overwhelmed and very stimulated by what I learned at these exchanges. And it just seems to me we're at such an important point where some of the pension funds and sovereign wealth funds really have some very rich experience while others are being formed. So somehow being able to have more detailed technical exchanges and really, I mentioned to the group, it reminds me back with the Latin American crisis when the major banks that had issues set up. I was then managing $50 billion for Chase Manhattan Bank. We set up the Institute for International Finance, and now that is the go-to place for exchanges and all this kind of good stuff, not just for the banks, but also institutional investors and insurance companies. And I think we need something to be able to really get deeper and to help everyone do what needs to be done. And with that, please join me in thanking our wonderful speakers.
Doing business in Africa. You can't afford to be without Africa Investor.